And whatever we do here before, now,
All right, good morning. In 10:04, we're going to start because we do have a lot of stuff to cover here. So as people come in, I'll just continue to let them in. That's not a problem. Okay, perfect. So today we're going to be talking about taxes, not only for you guys, because the example that I have is almost as if I was a realtor, but it's going to be very important too as well for your clients, your self-employed clients, for now and for the future as well, to be able to kind of really, learn how to really file your taxes. Because a lot of people, where they mess up is they don't go to an actual CPA. They'll go to a person that essentially is, qualified to be able to submit tax returns to the IRS. But that is not someone, but usually their job is more so to get you to pay the least amount of taxes possible, which helps. But our focus here is mortgages and how to qualify for a mortgage. And so that's really what we want to be able to, find out for our clients as well, and kind of what to look out for so that when you're speaking to them, like, hey, you might want to use your last year's taxes first to speak with Mike to see how those were done, and how much you would be able to qualify for before you start doing your 2023s and you start messing up, you put somewhere you're not supposed to, and things like that. And so what I'm going to teach you guys today is not only for you and how you guys put your things into place, but also so that you can easily look at your clients' tax returns and say, yeah, you definitely need to get this fixed or amended or things like that. Because I'm not able to. Will we be able to get a copy of the template? Sure. Yeah, Darlene. Yeah, I'll give you a copy. You're not going to be able to, or I'm not able to tell them what kind of income to put on their tax returns, right? I can't do that. I can give them tips, let them know, hey, this is what the underwriter looks at, right? This is your allowable debt to income ratio based off of $400,000 would be X, and then that way they can kind of work backwards, right? Um, but first off, before we jump into that, I do want to get into last week's news. We got a bunch of stuff. They kind of came up last week. I know that this week I believe we have PCE, which is personal consumption expenditure. But for December, the existing home sales came in, and they fell 1% from November to December to a 3.78 million unit annualized pace. And we're actually down 6.2% from the previous year in terms of just existing home sales. So 2022, we were 6.2% more in home sales for year over year than we were in 2023, which we figured, we knew that, right? It's not a surprise. But like I told you guys, that doesn't mean that home prices have come down. It just means the amount of homes being sold is much less, but also inventory is much less as well. I believe I didn't write it down, but the median home price did also increase as well year over year. I think by like 4%. I think we're like at 330 something. Obviously not South Florida. South Florida's like at 450 now, median home price, but nationally. NAR's chief economist Lawrence Young did say that the latest monthly sales look to be the bottom before inevitably turning higher in the new year. Mortgage rates are meaningfully lower compared to just 2 months ago, and more inventory is expected to appear on the market in the upcoming months, which, more supply is definitely what we need. We're right around 1 million homes available for sale at the end of December, which is about a 3.2 month supply based off of how home sales are going. Home builders. The National Association of Home Builders came out with their housing market index for January, and it shows a rating of 44. So remember, their index is rated from 0 to 100, where anything below 50 signals a contraction and anything above 50 signals expansion. So far, we're still below that 50 mark, but we're above our low of 34, which happened in November. I think December was 37, and now we're 44. So we're seeing that bounce back up to where home builders are being more comfortable with, or getting more comfortable with, building into 2024 and in the future. And we're going to see that in the next piece of data that we're going to go over. So housing permits, housing starts for builders did fall in December by 4.3%, which is a big decrease month over month. Housing starts are on pace at 1.027 million right now, which is indicative of if we were to keep up at this pace, how many homes would be built this year. So about 1.027 million. If we were to continue on this pace for home builders. Housing permits, though, did increase 1.9% month over month, and that's usually indicative of future building, right? Because your first process starts at pulling permits. You can't build anything on a piece of land without building permits. So those were up 1.9% in December from November, and they're about 6% year over year. So we're seeing more permits being pulled for new housing starts and things like that. Mortgage apps in the previous week showed purchases rise 9%, and they're up 20% year over year to start 2024. Refinances also rose 11% last week, and they're up 10% year over year, which shows a solid start to 2024. Remember that the Mortgage Bankers Association did forecast a jump of 20% in mortgages this year, so they seem to be on track to start. Rates hovered around 6.75% last week, but we did start the day today green so far, which is good. But let's see where this week leads us. On the graph, it looks like we're in a big space where we can possibly go down. We're closer to the top than we are to the bottom, which means that rates could kind of come up if mortgage-backed securities end up falling a little bit. So, drink some water. Lastly, here's an interesting bit of news. So remember when I went over the appraisals? I think was it right before we ended? Yeah, I think it was the last Monday Mortgage Minute for 2023. We went over the appraisals. I mentioned to you guys that appraisers usually make adjustments based off of time that a sale was done. For instance, a home that sold 6 months ago may get a positive adjustment as a comparable for one closing now, and that helps kind of boost the price or keep the price closer to that where the purchase contract is, because as homes sell, if appreciation is increasing, that means that the home that sold 6 months ago should be technically was technically worth less at that time, and so you get a positive adjustment for it. Well, the FHFA, the Federal Housing Finance Agency, basically Fannie Mae and Freddie Mac found disparities in appraisers' use of time adjustments for homes in majority Black tracts compared to homes in majority white tracts, which was around 13.4% compared to 18.4%. According to the analysis, when the appraiser came in at below contract price, the appraisers made time adjustments in 64% of the properties, but racial disparities remained. Time adjustments were used at a 45% rate in homes in majority Black tracts, 53% in Hispanic tracts, and 67% in white tracts. Now, here's the crazy part. It brought 52% of white tract appraisals from below the contract price to above the contract price by adding that use of sale time adjustment. The rate for Hispanics was 35% and 30% in Black tracts. So basically, when you are below that contract price, you guys know what happens. The seller may not be willing to negotiate. The buyer may have to come in with more out of pocket. When you're refinancing, that's a big issue. Different kind of things, right? So I thought that was a pretty cool fact that I saw over the weekend. I wanted to let you guys know. When we talk about, really purchasing and what we're doing within our communities, I want you guys to understand that even though fair housing seems to be a thing of the past, there's still things that are hurting Blacks and Hispanics from being able to purchase properties, like things like this, and people just doing it, and they may not be thinking about how they're doing it, but it is happening and we're seeing it. And so just being mindful of that, making sure that you're doing whatever you can for your clients at all times. Before we jump into the taxes, I'll be sharing my screen here. I did send a link in the chat. I'm going to resend it here. Tomorrow, NAREB is having their first general membership meeting of the year. I do want you guys to be able to come out if possible. It is at 5:30 in Sunset Lakes Community Center. I don't even know where my own event is. Sunset Lakes Community Center. Okay. 5:30 is networking starts. Event starts at 6. We'll be announcing some of the things that we're going to be doing for members and for membership this year. We've got a lot of cool things happening, a lot of partnerships that we are going to be making this year. I don't want to spoil anything. I don't think I can. Madam President Tamika might kill me. I can tell you when it comes to what I'm doing on my end with YRD, the Young Realtors Division, We do plan to do some big things this year. We are planning to have we're partnering with YPN in the beginning of February. I believe it's like February 8th. I got to double check. I'm getting the flyer soon and I can send it all to you guys. But I would want you guys to be a part of YRD as well. Just because I do want it to, YRD is really what we do here every single week, right? Where we kind of come in together and we learn together and we talk about the business and how to kind of continue to improve. So I want you guys to kind of do the same thing and be in these same organizations and groups. If you haven't thought about joining one, you should. YRD is going to be something where we are basically more so like family. Every event that we have is going to be intentional. We're not going to put you guys in a place where you guys are just being sold something when it comes to someone's, title company, someone's mortgage company. We want to put you there and we want to give you value. I know that when it comes to sponsorship, there's some things that we will need to be fulfilled, which we'll work out with them, but we want to make sure that you guys are in a room and you guys come into one of these things and you guys understand what we're bringing to you as part of RD. And I'll be sending you all the link as well to be able to register as a YRD member. Our launch party is February 16th. You guys will be getting that very well. We will be doing it on a yacht. There's space of 100. There's a space for 100 to 125 people on there. So it will be kind of a first come, first serve type of thing. We'll be sending out the links very, very shortly. The flyer's already almost done. And it will be open bar. So we'd love to see you guys there as well. You do not have to be a member to come. It is our launch party. It's kind of the grand opening for YRD. So we're excited for it. But definitely show up tomorrow to the general membership meeting if you have some time. It's a Tuesday, 5:30. I know some of you guys have kids and stuff like that. It's fine if you can't make it, but if you can, we'd love to see you there. We'll be talking about YRD. We'll be talking about NAREB for this year and stuff like that. Perfect. Shanika said she'll be there. Okay, now let's jump into tax returns, taxes. So I'm going to really just go over the Schedule C and the Schedule E. Those are the two most forms, the two most known forms that I usually see when we're doing these self-employment calculations. And they're the ones that people don't know the secrets to when it comes to mortgages. Okay, so I'm going to preface this by saying I'm not a CPA. Okay, I'm not an accountant. I'm showing you the numbers that I typically see and how they work on the mortgage side of things. Is this an in-person meeting only? The membership, yes. The membership meeting, yes, it is. It's what I see, right? And what I know could be done and added back. But when you're talking to your accountant, you need to make sure that what you're putting in those spots match up well enough so that way it's not an IRS thing, right? So in this case, the income that I received last year was $100,000, right? Just flat, simple. And then these are my expenses that I put on here. So I did $10,000 in marketing as a realtor, $21,000 in car and truck expenses because I pay my car every single month, right? To have a lease or have an installment, whatever. And my payments are about $700 a month, right? Or $600 a month. Depreciation, which I'll talk about now, and then deductible meals, right? Money that I spent out for clients and stuff like that, $5,000. So I made $100,000 after these pretty basic expenses. I had about $66,000 in expenses. So right now, according to the IRS, my profit is $34,000. That's what I actually profited in my business as a sole proprietor, right? Meaning that it's just me as a sole proprietor. The way that I'm treating the file, my Schedule C is not as a corporation or anything like that. Okay. And then I added here as well that I use part of my home for business, right? Some of you guys work from home. You guys do, you guys have your little home office. You do showings off of and stuff like that. And you use that mostly for your home. So I added back, the IRS allows me to deduct that. I did that as well. And I'll explain this method here. And so my total tentative profit is $32,500. So on the basis, right, you are only going to get approved based off of your taxed or taxable income. In this case,
Good morning. Can I have 2 dozens of donuts?
Wait, somebody,
Got it?
you got to mute.
Yeah, but
Whoever's
can you
on,
add one of them? Can
whoever's
you
on
put
their
sixth
team,
place?
Okay.
what
And
is it?
then what's the
Oh, Aisha, I got you. Um, 32,500, right? That's what you are basically, your income is. That's what on the base level we would be able to qualify you for. So you made $100,000, and now I'm basically saying, hey, we can only qualify you for about $3,000 a month, a little bit less than that, right? 2,800. Well, that's not correct in the mortgage world. There's some things that are put in here that I'm able to add back. And I want you to talk to your clients about as well. And this is something also that the CPA will need to talk to the clients about, because think about, even as a CPA is doing this and doing the taxes based off of IRS, right? And what the IRS allows, which in this case, the IRS allows all of this, right? I'm not saying that they don't, right? But they're never really thinking about how this could help somebody when purchasing a home, but also helping them with making sure they don't pay $100,000 of income worth of taxes, okay? So in these expenses, on a Schedule C, it's very simple. There's only a couple things that you can add back when you're looking at being able to qualify for a mortgage, okay? So in this case, if you have a business expense of advertising for $10,000, I cannot add that back, okay? Car and truck expenses, $21,000, I cannot add that back. Depreciation, I can. So depreciation, your car is something that you're using, and your car also depreciates every single year, right? It's worth much less every single year because the more you drive it, the more miles you put on it, things like that. That is something where I'm adding on here to help me with for tax purposes. But this is something that Fannie Mae and Freddie Mac allow me to add back. Okay. So this will be something that I'll be able to add back to the income. Deductible meals, 5,000. I can't add that back, unfortunately. Down here, I'm a realtor. I use a portion of my business to be able to do business. I do use a portion of my home to do business. So this is a very basic question, right? Enter the total square footage of your home. I just put 1,800 on here. And then the part of your home used for business. 300 is on purpose, because if you're doing what we call the simplified method, really, the simplified method where you're not filling out a full 8829, which is a mission, the maximum that the IRS allows you to use of your home for business purposes is 300 square feet. So that's why I put 300 there. Times 5 is $1,500, because $5 is also the amount of money that they allow you to add back for that. Okay, so you're basically getting about $1,500 of your home, or of your income is actually expense from that home. But same thing, Fannie Mae, Freddie Mac allow me to add this $1,500 back in. So instead of me qualifying you based off of 32,500, we're adding back in the 1,500 that you use for your home office. That's 34,000, and now we're adding back another 30,000 in depreciation from your car, $30,000. That's $64,000 now that we're at to be able to help you in terms of your qualification for a mortgage. So you start at 100, you're paying taxes on 32.5, 64,000 is the number I'm able to qualify you for. But we can also take it one step further. So down here, when you're using your car as a business for your business, right? You're also able to deduct mileage here on your taxes. Okay. So what I love to see is usually when somebody puts the miles that they use their car for business purposes on here. And this is because Fannie Mae and Freddie Mac allow us to use a percentage of these business miles to add it back towards your income. So in this case, if I did 30,000 miles last year, the number that I can use is 0.26, 26 cents to the dollar, basically, is what it is. And that'll give me an extra $7,800 of income that I can use. So plus the 64,000, I'm at $71,800 of income that I can use for you, and you're only paying $32,500 of income worth of taxes. Okay, does that make sense? Which 30% of that is basically you're paying $10,000, but the income that I could use for your mortgage is $72,000. Okay, that's a good trade-off in terms of how you're calculating your taxes. You're able to be very specific. So the two things that we're able to add back, or the three things that we're able to add back on the Schedule C: depreciation. So make sure that you're intentful, make sure that your client is intentful. Hey, do you do something for your business? Even if you rent out or if you own a building, all right? That building depreciates, not rent, but own. That building depreciates. You can add that. Your car depreciates, right? Those are things that I can add back 100%, one for one, back to the income. If you use your home for business purposes, I can add that back towards your income. And then your business miles, I'm able to add back 26 cents to the dollar on every single business mile that you did. Okay. And so now you're paying taxes on $32,500 and we're qualifying you based off of 72,000. Let's take this one step further on this Schedule C. Your car is a business expense for you. You're using it for business purposes every single day, but you're making a mistake because you only have a personal bank account. Okay. And so you're paying your car, you're using your business funds are going to your personal, but you're paying your car out of your personal account. I want you to do this. And I want you to tell your clients to do this as well. Make a business account. Okay. Start up an LLC. It's very simple on some biz, 20, 30 bucks, and use that business account for everything that you do within that business. It does not matter. Put all the income on there. Your business bank statement, as it looks to the bank, the amount of money that you use on that, you still have a regular account number and a regular routing number. So if you need to pay bills on there, you can still do it through your business account. But the purpose and the benefit is that now this $21,000 that you paid from the business, technically, because we can see it for the last 12 months, I can't add back this income. But what I can do is I can remove your car as your liability when I'm helping you qualify. So if your car payment is $700 a month, and you showed here on your Schedule C that you paid it out of that's a business expense for you, and then you also show it on your bank statements for the past 12 months that it's paid out of your business that you're receiving money from, I don't have to hit you for that liability. So now I'm qualifying you based off of $72,000 a year, plus I'm excluding $700 on from your credit up for your car payment. What part, Ladarius?
So just about how you're able to pretty much deduct the expense for the car from the income, or not as a liability. Let me say that.
Yeah. So if you have a business account, right, and you're paying your debts through your business, and you're putting them as actual business expenses on your taxes here, like in your Schedule C, all we have to do is show proof of 12 months of business statements showing that the car is being paid out of the business. You're showing that it is actual business expense. You're a realtor. We know that you use your car a lot. And now you're showing on your bank statements that all the money that you're getting into your business, your car is being paid from that business bank account or from that business statement. So now, because even though it's on your personal credit, it's going to be separated because it has been shown to be a business asset and liability, according to Fannie Mae, Freddie Mac, and the IRS. So getting that business bank account and basically making your payments out of your business will allow us to be able to exclude that car as a liability from you on your personal credit. It's very similar to having an SBA loan, right? The SBA loans that came out a few years ago, they're starting to show up on people's credit. That's a small business administration loan. It's on your personal credit, but technically speaking, you're paying that from your business, right? Most of us are, especially if you have a business account. It's the same thing. I don't have to hit you for that SBA loan. I don't have to hit you for your car expense if it's for your business, if it's for a business purpose and it's being paid out of the business account as well. So you're basically getting a double dip on this one. Exactly. Correct, Ladarius. Okay. So now you're paying 30% of $32,500 as your actual allowable income to the IRS. But now I'm using $72,000 of income for you, and I'm excluding your car payment by doing two basic things: making sure that you're putting the bulk of your expenses in the right spots, which is depreciation with car and truck expenses, and then I'll also adding those business miles here. Okay, and then also getting your business bank account and paying your car, showing 12 months of on-time payments from your business account will help us exclude that $700 a month, which is pretty similar to being able to add that income back for you. Okay, that's just on the Schedule C. Good stuff? We're gonna push over to Schedule E now. So Schedule E, you own rental properties. Your clients own rental properties. This is the one thing every time I have a conversation, not every time, I would say 8 out of 10 times, people do not put their properties on their tax returns that they own. And it's because they don't want to pay taxes on it. Well, newsflash, this actually helps you. The IRS, the way that the IRS is set up and the way that the government is set up is that they are very pro owning properties, right? You get a bunch of tax benefits, 1031 exchanges when you sell, different things like that. You get so many tax benefits, including on your Schedule E. Okay? And Fannie Mae and Freddie Mac also are okay with that as well, but they want to make sure that it's on your tax return. Okay? So no matter what, it's about putting your properties on your tax return. So in this case, I got 2 properties. Okay? 111 Main Street in Miami and 222 Main Road in Hollywood. Okay? The first one has been rented out all of last year, 365 days. The second one, I bought it in June, so it's only been rented for 180 days. Okay? I bought it in June, I only rented it for 6 months. On my first property, 101 Main Street, I received $3,000 a month consistently, right? On my lease. That's $36,000 a year. On my second one, I received, this is a duplex, right? I capitalized it as a multifamily. This is a duplex. I did $4,000 a month times 6, because I only rented it out for 6 days or for 6 months. It's $24,000. Okay, so now I'm putting the actual rents that I received on this. Okay, and now there's expenses here that kind of come into you being a landlord, right? In this case, I put commissions. I hired a realtor and I paid half a month's of rent to the realtor to be able to rent out my property. That's why that $1,500 is there and that $2,000 is there. Okay. Also, I paid insurance. I have property insurance. I have homeowners insurance, right? My homeowners insurance on my single family is $3,000 a year. My homeowners insurance on my multifamily is $4,000 a year divided by 2 is $2,000, right? Legal, other professional fees. I paid a lawyer to draft up my leases and make sure I was in the green and everything like that. Mortgage interest paid to banks. So at the end of the year, you do get a form from the bank that basically states how much interest you've paid them for that year, which is a tax deduction for you. Okay. So that number goes here. In this case, I just threw in some numbers, 10,000, 8,000, what I paid in interest. Okay. Repairs. So on my first property, I had to replace the roof. Okay. It started leaking, a bad storm came in, it started leaking, I had to replace the roof that cost me $20,000. Okay. And then taxes, you pay taxes every single year, your real estate taxes, $7,500, $5,000. Okay. And then of course, boom, I use depreciation. So depreciation, if I'm not mistaken, the way that it's calculated on your Schedule E is based off of your all-in, your cost basis on your property. So, in this case, if I bought this property for $300,000, and my all-in was 310, 315 with closing costs and everything, divided by the total years left, or your total lifespan for that property, which in this case I just put 30 years. And that's where I got this 10,500 number. And then on this one, I estimated that I paid 400 for this property, and 420 was my all-in divided by 30, gives me that depreciation of 14,000. And just like on your Schedule C or your Schedule E, this will also be able to be added back. Okay. So to the IRS, I lost $25,500 on these properties. Okay. That's the amount of money that I lost that year. You can see it. So if I'm showing $32,000 on my Schedule C of income, and I'm showing a loss of $25,500 on my Schedule E, because both of those are in my taxes, to the IRS, I made $7,000 last year, $6,000, right? Whatever that difference is. But to Fannie Mae and Freddie Mac, I'm using $72,000 to qualify on my Schedule C. And now my Schedule E, almost everything that I put on here could be added back. Okay. So let's say on this property, on a property, your mortgage is $2,500. Okay. Let's say. So you're making $3,000 a month. You're technically about $500, $500 a month of profit, right? So commissions that cannot be added back at all, right? Fannie Mae, Freddie Mac don't allow you. So that's $1,500, $2,000 on both properties down the drain. Okay. And actually what I'll do here so you guys can see it in green is we'll do 1038. Or okay, so let me get this one. Put this here. All right. So we'll do property 1, property 2. We already know this was 12 months, 6 months, right? Hold on. Where am I now? Go back and share my screen. Okay, 6 months. The income that I received was 36,000 on this one. On this one was 24,000. Okay. My total expenses, like we mentioned, with everything all in, was 17,500. Oh, sorry, no, my total expenses with this one was 53,500. And then my total expenses on this one was 32,000 after all of the things that we deducted, right? These are the numbers that I'm taking from right here. That's it. My total expenses, all of these things added. Okay. Now, insurance is something that I can add back. That's part of my PITI, right? So insurance expense, I spent $3,000 on this property and I spent $2,000 on this one, adding it back. My mortgage interest paid. All right, so on this one, I paid $10,000 is what I put here, and I paid $8,000 on this one. Okay, retry. I put 80,000 by accident. 8,000. My tax expense, 7,500 on this one, was 5,000 on this one. I'm literally getting from my Schedule E and adding back everything that allows me to add back. Homeowners association dues, I don't have any on these properties. Depreciation, look at that. 10,500, 14,000, my depreciation. Enter any extraordinary expense. This is where that one repair goes. So I want you guys to think of this, okay? I had to replace my roof. It was $20,000. Am I gonna have to replace my roof every single year? No, okay? Your expense, your repairs, they cannot, if they're gonna be a high number, you're gonna have to think about this in the mortgage aspect. If you're replacing air filter, electrical outlet, small things, you're not going to be able to really get that repair or add it back. They're very, very particular when it comes to repairs and making sure that if you just bought the property and it's the floors, right? You just redid the floors. You're not going to have to redo the floors again for years to come. Those are repairs that you're going to be able to add back. You're not always able to add back repairs. And when you add those back, they will ask for the invoice and for the paperwork of it, basically the invoice of the work that was done and completed. Okay, so you do have to have that as documentation. But if you did your roof, that should be easily attainable for you to be able to get within your email. But I want you guys to know that repairs are not automatically added back, right? It has to be an extraordinary expense, something that's a one-off. Okay. So now my actual adjusted rental income is 33,500. My actual adjusted rental income on this property is 21,000, right? And this is for the amount of time that I had these properties rented out. So my actual income on this property is $3,500. My actual income on this property is $2,792. Remember, I told you that my PITI on this one was $2,500 a month. My PITI on this one is about $3,300 a month, right? I'm showing a net income to Fannie Mae and Freddie Mac of $300 on my first property and $200 on my second property. And to the IRS, I'm showing negative $25,500 for income. And so now I'll be able to use this as actual extra income on my application to help me approve for a little bit more. Now, obviously, this is not going to give you a huge increase in your approval, but what it does do, it doesn't force us to basically hit you for that liability. Because if you have these properties and they're not on your Schedule E and you purchase them within the prior year, you will have to put them on your tax returns. If you don't, I have to hit you for your full PITI, even if you have leases in place, even if you show proof that you've been collecting it, because all they care about is making sure that you are showing the IRS that you own these properties and that you're basically paying taxes on them, which in this case, you don't have to based off of your Schedule E. Where's my Schedule E? Oh, I had it in another. based off of your Schedule E, right? But if you own that property and you bought it in the previous year, it would have to be on your tax returns. The only time we're really able to use a lease is if you're purchasing this year and you bought your investment property this year, right? So let's say 2023 wasn't over and you're trying to qualify for a loan in October and you bought a new investment property in February. And at that point, the only thing I can use is the lease because it hasn't been you haven't even finished the tax year. So there's no way for you to be able to put it on your tax returns, right? That's the only time I really can use a lease. If you purchased a property in December and it wasn't even in service, you still technically have to put it on your Schedule E, but there's a way that you could do it where you basically Fannie Mae will allow you to use a lease at that time, right? So you basically will put, my third property here, fair rental days, right? 15 days. My lease shows that I rented this out for 15 days. And so the rents that I received are very small. All of this stuff is very small. Now the underwriter looks and says, yeah, okay, the CD that this, or the property appraiser office shows that this was closed in December. His lease shows December 15th. Okay, Fannie Mae will allow us, with all the documentation that we have, to be able to use the lease for the third property. But it would still have to be on the Schedule E, no matter what. You own the property. If you purchase a property within the prior year and it's an investment property, it has to be on there. But there's ways, all of these things here, most of these things here, you're able to add back. So now to the IRS, you did $32,500 of income as a sole proprietor, and you lost $25,500 this tax year off of both of your rental properties. But to Fannie Mae and Freddie Mac, you're actually qualifying with $72,000 of income. You're excluding your car payment. And on top of that, you're adding in an extra $300 and $200 on both properties that you have to be able to qualify for a home. And that's how you avoid jail, guys. Any question? You guys good?
Mike, this is Darlene. Good morning. Do you do
Good
your own taxes or do you work with a tax preparer?
No, my CPA, I work with her. She used to work for the IRS. So that's why I'm like, just take care of my stuff.
Okay, we need your information.
I got you. I can send it.
Alrighty.
Yeah, I'll put it here now in the chat just in case anybody wants her info.
I have a sidebar question. Do you do refinances?
Yes, I do.
Okay, thank you.
No problem.
Do you do referral fees?
I can't give you a referral. I can't give you like a referral if you're not licensed as a loan officer. I can get in really big trouble for it. But we can talk about maybe the next, because sometimes I get leads very rarely. We'll work something out. But I can't
Okay.
just give you a referral fee.
Okay.
Christine. No problem, guys. Any questions that you guys have? No problem. Okay, well, we'll see you guys hopefully I see some of you guys tomorrow at the general membership meeting. If not, we'll be on next week at the same time, 10 a.m. If you guys have any clients or leads you guys want me to speak to, any consultations you need me to do, you guys have my personal number. For those of you guys that don't, here it is. We're here for you guys. Thank you all so much and see you next week.
Thank you.
No problem.
Thanks, Mike. Have a good day.